What's up, YouTube? It's Joe Catrapalia sitting on the couch making some money investing in fractional real estate online as usual. Today I'm going to look at another property on Lofty. This is a short-term rental in Pittsburgh. It's one that came up in the last couple weeks, I think. Still selling out at $50 per token. Um, for the most part, yeah, they still have 500 listed at $50. I'm sure they probably have more. If you've been watching my channel for a while, for the most part, I have not been buying at $50 or above, but I want to just go through the full due diligence on this one, see if there's anything we can learn from it, um, and then, figure out if this is one that I want to buy when it dips. And I hate to say when it dips, but I really don't even think it's a if, especially with the short-term rentals where the income is variable. I think that it's just a matter of time before all of them dip. Some of them, there's been some rare exceptions that went straight up, but the vast majority have not. So, starting off, want to check out the market as usual. Pittsburgh, it's interesting. They have a lot of good press as far as things happening there. It was a shrinking market for a very long time. It looks like they just have a turnaround, and you can actually see the trend was lowering, right? It was shrinking quite a bit in the 80s, a little bit less, a little bit less, a little bit less. And then this most recent one, yeah, a tiny bit of growth. What's funny is this story has resulted in a whole lot of investors, thinking that this is the time to get in there. Thinking there's a lot of upside to Pittsburgh. It's one of the um, more affordable larger cities. I'm not sure I'm sold on that, but it is. I'd take this trend over a one that's just continuing to shrink as far as the population goes. Looked at the greater Pittsburgh area, and similar story, not exactly the same. But again, the turnaround in this is actually the most recent census where the one before or the city didn't actually start growing until this is just the estimate. There's a whole bunch of other stuff you could look up about Pittsburgh. It's a big city, and so it's a market I'm a little bit familiar with. I lived and worked in Philadelphia for a while and in Reading, and every once in a while I'd look at deals out in Pittsburgh. So a little bit familiar with it, but not really enough for that knowledge to be useful. But I think that I at least have looked at it enough times, the market enough times to have some biases against it, right? But I think you do, like I said, I mean, there are a lot of reasons people think it's turning around. Um, I think that there's plenty of additional due diligence you could do on the market, but I don't hate it, but I'm not like this isn't like the Texas Triangle, right? It's not a spot that I just am like all in on where, I'd have to have a pretty compelling deal to buy something here. But if you've watched any of my other videos that I bought stuff in Cleveland, I bought stuff in Chicago, like I am willing to do it if I'm getting the proper discount and I think that I'm going to be able to make some money. So, in any case, not the best, but not terrible. I wanted to look at spot crime right away, again, probably just because of my biases about that city. Um, I think that a lot of cities, you have to look out for crime, especially if I'm doing a short-term rental. Um, if you're going to have guests, it can be a big deterrent, right? And so this one, it was actually pretty interesting. I pulled up this address and it didn't give me any right there. It kind of spread them out. So I thought that was kind of a good sign. And then, when we look at these, we always want to look at, well, how many days did it take to accumulate all that? And it's going back pretty far, right? Like this is more than a month, which is a lot for spot crime. So that made me feel pretty good about this. The closest thing that happened to it was a theft. Obviously, or I think this is probably geocoded wrong because I don't think there was an assault in the river, but I don't know. I thought this was a little bit promising to see. Maybe right where we are is not too bad, or is actually pretty good. Looked at the flood map because it's right by a river. looks solid as far as that's concerned, so I was pretty happy there. I'm going to just kind of burn through a lot of this because a lot of it's stuff that we're doing every time. I do want to mention it though because I think it's, one of the things, I'm trying to do is just share my real estate experience and due diligence experience. And a big part of that is just going through the motions on every single deal, right? Never getting complacent and skipping some of the things just because we like something. And so I'm trying to, really go through that and not just mention a tool one time and never go back to it, but actually take a look at it every time. As usual, if you're, if you're looking at this property too, or if you've done a little research and there's some other info you want to share about it. Oh, my cat's about to knock something over. Let me just move that. I'd be happy if you did that in the comments. And then I also recently started a Discord. I'll put a link in the description below for that. You can jump in there and we can talk about some of this stuff too if you want to. While I'm thinking about it, please like and subscribe if you haven't already. And there's also links in the description to all the sites where I'm buying fractional real estate right now. Please do your own due diligence on all the sites, on all the properties that I cover. I'm just trying to share some of my knowledge and experience, but I want you to make your own decisions on everything. I don't think that I could ever cover enough in any property video to really let you know whether or not it should be the right thing for you. All right, enough of that. So the next thing I did is look at the FEMA hazards map. It shows up as relatively low risk of, I'm using this expected annual loss tab, not the risk index. Actually, I think it ends up looking even better when you use the risk index. But what that is, it's because I think they have a really high community resilience score is what's doing that. Let's see. I forget exactly where that's calculated, but I'm pretty sure when I was looking at that, that's why. And so I don't think that's really, that's not really applicable to what it's going to cost us as investors if something happens. And so, I'm just looking for how likely is there going to be, any of these disasters. And so I like to just scroll through this info. You can definitely dig into these risks a lot if you're going to plop down a big chunk of money on one of these. I'm trying to spread my risk across a ton of properties. And so, you know, I'm not doing maybe as thorough of a due diligence as I would if I were going to buy the whole property. Obviously, I'm not going out and visiting them or anything like that, but I'm trying to get close, right? And so if there's anything, if when I scroll through here, if there's anything that jumps out at me, I always stop, take a look, see if there's anything I need to worry about. Always, always I use this, Google Street View. Want to just take a quick walk down the street. I never love to see this. So this is the subject property. I never want to be the nicest home, right? Like, or significantly nicer than the properties next to me. So, that's not ideal. This is not, if I'm going to go stay in a place on a vacation, this doesn't scream vacation spot. So maybe this Airbnb, they mentioned that it's down the street from one of the trendiest areas. So maybe the location is so strong that you'll get that, but I don't know. It doesn't scream hotel-like experience. Or and at the end of this video, I'm actually going to show you one that one of my clients did last year here in town. To just I think that sometimes I might come off as a little bit of a snob when it comes to the STRs. My team sells a whole bunch of these here in San Antonio, and I think I've just really learned like what I think does well and what doesn't. And I realize that might not stay completely, static across markets, but I think that there are certain things that do as far as I can tell. So didn't love this walk around. If this was a long-term rental, I think I'd be perfectly fine with it as a short-term rental. I mean, it is attractive from the front, and I think that that's what it looks like now when we look at the pictures. I'll bring those up later. We'll go through those. Well, actually, let's do that now because I think I'll probably start making some comments that will make you wanna look. So you got the hot tub. You have a really nice kitchen. They have sort of over the top decor in the rooms, and that's very in line with what we're doing on a lot of properties because you want to have that. you just want to have the wow pictures, and so sometimes that leads to a little bit of over design on the inside. Outside, they just have a little sitting area, have a hot tub. It seems like there's not really much else they could do, but it looks nice, it's clean, it's designed well. Um, they're using a lot of color and whatnot. It doesn't scream, they do show you a couple of things that they have to do there. It looks like, ping pong table, pool table. But it doesn't, scream like, uh, well, let me show you this. The host, she talks about, what does she say here? My homes are family playgrounds for fun. Uh, it just doesn't really scream that for me, right? I mean, but it's relative, right? But it is, depending on why I was staying there, I could be perfectly happy with it, but I might not be, right? But so it's attractive on the outside, but not necessarily the neighborhood as far as, you know, I mean, it's not bad although either. I mean, I think for a lot of older cities, I mean, this is what you're going to get until you get to pretty high end. But so let's jump a little bit into. I'm going to go back and compare and look at the Airbnb a little bit, but I want to first jump into the values, right? So they're bringing this to the platform saying the underlying asset price is 404. Um, let's see, we have, where'd it go? That's not it. That's not it. Let's look at this one. Yeah, here we go. So this is the appraisal. It appraised at 385. So again, they're bringing it to the platform, I think at the maximum amount they're allowed to. I was doing some other math here, and so we'll get back to this other math. But so 385 times 1.05. Yeah, the 404 250. So that's just the maximum premium they're allowed to bring it to the site. They can come, go 5% over the appraisal if they want to. A lot of hosts are deciding to do that if they can, still give you the rental yield that you want. I really don't like this. And then on top of it, you're paying for the furniture. So some of them, if they're, that's why this cost here is so large. Some of them, if they are not charging any premium for the furniture and are just doing a premium for the asset as a whole, like I'm kind of okay with that. Um, I'd really like to not be paying, the 5% over the appraised value already. And then, so I looked it up on Zillow, very similar estimate. So that looked good. Um, Realtor thought it was worth a little bit more than the 385 though, right? Not, let's see, not the 404. What do we got here? Oh, and I closed it already. But right around there, right around that 404. So that's good. Redfin had a much lower estimate and a lower range. Um, it also though is looking at the wrong home, so I don't know. Some it has the right address, but the picture is not right. So it's this one here, not this one. You know, I've got an appraisal. I've got a couple sites that give me a number that's really close. Homes.com. It's right in the range of there. It's kind of on the high side, but like none of these are really. And you can see what this looked like before, which is quite a bit different than it looks now. So that's kind of interesting. Um, but it is, nothing to justify the premium though. So that's one thing. Am I going to buy it at 50? I think the answer is really no, but I'm gonna do a little bit more math to see. So one of the other things that I always do with short-term rentals is I'm going to go to my AirDNA right away, right? I want to know um, what I think it's going to bring in as far as revenue. Uh, I actually found the exact property on AirDNA. And it's so, this is usually just a trailing 12 months, and it's saying, okay, the total revenue was 49,800. When you look at that, it looks like it's actually pretty in line with a lot of the others. Very low occupancy, right? 51% occupancy, um, $269 a night. You can see we're sort of in this peak period, right? Although December went down a little bit, but this is a little worrisome for me because, people are buying this property because of the rental yield. And this yield here is really being created. Um, they're always just paying out the yield from the annualizing the prior month, right? And so when you do that, and we look at this, that's a little bit problematic, right? Because we're going to have some much worse months, it looks like, um, going forward. Now, one thing that, and there's a lot of the comps that did worse. I saw this one that looks like it's a little bit better, but it's larger. So I don't know. This made me feel like the 50,000 is sort of the top line revenue. Although I know, and I'll show you in a minute, one other thing. Uh, that was in line with the income that they showed. So this was their year-to-date income. It's a little bit higher. One of the things they're using a HostWise, which is a professional management company, and one of the things that they do and charge for, and I was looking at um, their management agreement, and they have, let's see, is this the one? Yeah, they do direct bookings. They charge 14% for it, which is, as high as almost anything else. But that might explain why AirDNA is not picking up all, 100%. But it got very close, right? It was 49 and change, and we're at 50. So that was good. A couple other things about though the management agreement. Let's start closing some of these tabs so I don't. They do have, and I've got this page separately. I don't know why this was messed up. Um, but they do have, I think the way this management company handles their maintenance is actually pretty good. They want to be able to just fix anything that's $500 or less, uh, without prior approval. And I think that's great because when you have guests coming, you can't be waiting for an owner to approve something, especially when it's a situation like Lofty where there might be a vote. So anything under $500 are just going to take care of, and then we'll find out about later. Um, they have their own in-house maintenance team, and if they're able to resolve the issue, they charge $65 per hour. At first, that might seem like a lot of money, but they're doing it in 15-minute increments. So if it only takes them 15 minutes, you're not getting a huge charge, and they're not charging you any drive time or trip fees. And so I can imagine, depending on what the situation is, this seems like a really good deal to us as owners. Because it is, and they have it's higher if it's emergency or after hours, but if you try to get somebody out to your house that's an actual contractor, even if it's just for a small thing, you almost always are paying a trip fee, or like minimum, it's tough to do something for under $100, right? So if someone shows up at the property and is able to fix something minor in 15 or 30 minutes, um, I mean, this is just very affordable. So I like that about the management team. They charge 22% of the room rent, which is not the total, but of the rent itself. So not the taxes, not the cleaning fees. Um, I think that's a very fair amount. I think that for short-term rentals, 25% is perfectly reasonable. So 22, 20. Sometimes I get scared when it's too low because you're not really um, I want to make sure that the manager doesn't go out of business, right? Like we had several here that were charging 15%, and it seems like I can't think of one that is still in business doing that. And so, so you want your property to be worth it for them too, right? So that's one thing. Uh, I think that's perfectly fine. So that was good. Um, but so going back to the numbers, right? So this was last year, 50,000 gross. 10,000 went to the manager, platform fees, cleaning, um, all the way down. The totals, I actually did this math because this is what they provided in the Dropbox for their profit and loss statement, which to me, one of the things that I think sets apart a lot of the better co-owners is the how well they communicate and give you information. And like to me, this is just terrible, right? Like this is not like they operated all last year. I could tell by looking at they gave us their their bookings for the last couple of years actually, And so they should have a month by month P&L that they can provide. And the fact that they don't worries me a little bit. But this total is actually their net operating income before making their mortgage payment. I want to show you why I care about that. This is the mortgage payment, not including taxes and insurance, right? This does not include taxes and insurance. This is just principal and interest that they're paying. This is what the math I was doing before, right? So we have $1,913.05 times 12. Almost $23,000 is what they're paying, is missing from this math here, right? You have no interest, you have no principal. And so last year, although I think this is a new loan, I think I remember seeing that this loan just happened. Um, yeah, December 13th of last year. So this is a new loan, but if that were in place with last year's numbers, they're underwater by a significant amount, right? Like I mean, 23, like you're losing five or $6,000 a year. Um, if as the entity, as the investors, we had to pay for that loan, right? Which the way Lofty is set up, we're not paying for that, right? Like the co-owner pays for the total note. But that makes me very worried about the future prospects of the property. Um, the co-owner is able to sell out because of the way that works, and they're providing a high yield because of it, right? Because we're not on the hook for that debt. And it is relatively highly levered. Let's see, do we have it in here? It is. I mean, not it's not highly levered, but it's um, this is created just from the leverage. It's created from two things, right? One, it's because we're analyzing one of the better months of the year, and two, this is the loan balance. So let's look at what that really is, right? It's not a high percent, but it's enough that it's compared to some of the other ones I'm invested in. Let's just do that against 400,000. 68%. Let's do it again about the 273, 600 divided by 3. It's okay, so 71% against the appraised value. A lot of people would call that low. For me, I'm a relatively conservative investor for a short-term rental. Um, I don't know. It's not super high, but it's not. I would want it to be lower, especially when you're not covering that debt with your income. Like it's just not there, right? So, and the reason I want that bigger cushion is so if I need to sell it in a hurry, I'm not going to have a problem with that. Um, oh, and this is another one that they're providing a rent credit, right? So the co-owner is actually um, paying a rent credit for December to match November's gross, which we saw November was the best month. So they're really artificially inflated their December number in order to hit this, right? And they're paying to do it, right? I mean, and they're open about it, but it is something that when I'm looking at that math, this 21% yield is not going to stay here, right? I mean, it's going to dip, and then which is why we're looking at the property on its own, right? And so um, you might say, well, okay, let's just look at the cap rate because that's the property on its own. But again, that's using this annual gross, which is just this number is annualizing the December rent with the rent credit, right? And so that's why this looks so strong. Um, and let's just double check that and make sure that's exactly what's happening. I always like to, I can't always get my math to work exactly right with lofties. The more often I'm able to do it, the more comfortable I am. So let's see, 5814 times 12. It's not exact, right? So we got to 69,768, and they are 70,000. So yeah, we're still about $1,000 off by doing it that way. Not exactly sure where the discrepancy is. Um, but so what I really want to see is the property itself, right? And so when we were looking at the $50,000 gross revenue, if you remember, one of the things I like to do, I like to be close to, and I know I've said 20% revenue to price ratio. Um, I don't really mind being lower than that, but like I want to be in the at least in the very high teens. But so that's kind of my standard I'm shooting for is a 20%. So we have about $50,000 in top line revenue. Divide it by, um, I mean, at this price, your market cap's actually is the 432, right? So divide that by, but that includes the furniture cost. And when I'm doing this in real life, it's before we've put furnishing and decor. So I want to just do it based on the 404 that they're using for the underlying asset price. And so you can see that gives us a 12% revenue to price ratio. This would be way too low for me to want to be in there. But so what would it have to be? Let's say I want to get to 18%. So 0.18 divided by 50,000. Oh, I did the wrong thing. Let's go the other way. 277,000. That's really what I'd want to get to with the revenue that they're going right now, right with the actual trailing 12 revenue. So you can see at the, and compare this to the 404, you can see we're way lower than I would want to be, right? So like let's divide that by 404, 250. So we're going to need like a 30% dip, a 32% dip for me to want to have this just based on that one top line metric. Now that's a number that works here in San Antonio. But I used 18. I didn't even get to 20, right? But one of the things they definitely have lower property taxes for the same property here. So, when you back out some stuff, maybe you can go a little lower, but 12 just seems way too low for me. But so at least it gives us sort of a target, right? Like where we want to go. Like once this, so we're our value wise, we're about 5% over. Um, I'd like to actually be at a little bit of a discount. So, maybe we need to dip. If you had like a 10 or 15% dip, you don't get to where I'm really happy with the income, but all of a sudden we're picked up a little bit of equity. And so that's one of the things that I really go back and forth on is when I'm looking at, so kind of like the Harvest, Alabama property we looked at, um, it's a little bit lower yield, but I know that I'm also picking up a big discount in the equity at the price that it was at when we were looking at it last week. And so, you know, figuring out where that trade-off is something I'm not 100% sure on, right? And so one of the things that I'm just really doing is comparing as many of these as possible and just picking the best options, right? Like I don't necessarily think, any of the discounted ones that I'm getting the real good discounts on, um, I don't know which ones are going to end up being the best deal, right? And so I just want to compare them, get the best ones that I can at the time. It's why I'm always, what I'm buying each week really changes based on where those numbers are, but I'm trying to do the work up front to be ready for that, right? So I don't know. I don't know that I'm buying this at 40. Definitely buying it at 35. Like no question, I would be jumping in here at that. Again, just because that's my number, it doesn't mean it should be yours, right? You want to do your own due diligence. I already showed you this is their manager. Um, this is the co-owner that brought it to the platform. So both of them are super hosts. She's got a bunch of reviews. So she's been doing this for a while. Uh, and still we just had like not great income, right? So this is the actual listing for the page, and I think it gives you it's 3 bedrooms, 1.5 baths, 8 guests, and so this is kind of what I wanted to talk about and compare it to one that my client's doing. Let me just make sure I don't have something else I want to talk about first. That one and that one. Um, this is where I think why I think this one is going to struggle. You know, what I found is there's two types of short-term rentals that do really well. There's ones that are doing just giving you an absolutely amazing experience. Buying a more expensive property but getting an even higher premium on your room night and being full all the time. And so that's what I sort of when we talk about it in our business here, I refer to it a lot as, we're just in an arms race when it comes to amenities, right? We're not, this type of property is never competing on price. We're always competing on amenities and experience. I think that can do very well. Uh, Usually that has more bedrooms. A lot of times it has a pool. Now up here, I don't expect you to have a pool, but I would want something that's a kind of wow outdoors, and I don't know that this is it, right? Like if I look at other places, I'm not sure. Oh, that's one thing that I had missed too, is they have this little air hockey, so that's fun, right? So that's one added fun room that I missed when I was looking before. Um, One of the thing that is weird is that I think they painted or they pasted the same description in every part, because like when we're talking about the exterior, it talks about air conditioning, backyard, baking sheets, barbecue utensils. Like I don't know why that keeps showing up. I don't know if that's a Airbnb problem or a them problem. And then they have pictures of the area. Like I think for what they have here, oh, that's my cat knocking stuff over there. It's young. It's still learning what the house is like. Sorry about that. But I think for what they have, they've done probably everything they can do to make this a good um, deal. But it is, I think the property itself is just not the kind of property that I'd normally recommend to a client. Um, Again, I'm a real estate agent, but I'm not your real estate agent. I always thought, yeah, I know I over disclose. It's because I used to be an attorney and I'm super paranoid about, uh, I just want people to really do all of their own research on stuff and make those buying decisions and not just take my word for anything. Um, but yeah, I think that it's just not the type of property that I think would do well. So I think you can do that, right? The really high amenity. And then the other end, I think you can compete on price, but then you just have to be super scrappy. You have to have a low basis. You have to, um, I think a good example of a property that seems to be competing a lot more on price than experience is all of Earl's properties, like these Madison Ave. And I'm not saying it's a bad experience or anything, but he's clearly, he's not going for wow here. He's going for, this is an affordable stay in a clean, safe property, but not, nothing over the top. Like I think you can do well with this type of strategy. Um, and the other strategy that you can do well with is something that, really something like this. So this is one that one of my clients bought last year. Um, they did this to the backyard, right? It didn't look like this when they bought it, but they bought a big piece, a property that had a good sized backyard. It already had the pool, that's why it's kind of an older pool. But they added a pickleball court slash half court basketball. They added what is that? 5 little mini golf holes. They really go all out and I don't think, like I said, I mean, that's not what this home was that they have, right? Like you're not, they didn't start with a home as big as this one. Like this is I think 4 or 5 bedrooms. It was a big home, had a pool, had a big backyard. But I think like this type of experience, you're just having something that's really over the top, um, is pretty necessary today if you're trying to compete on amenities and not price. And like you can see there inside, it's done well, but again, it's sort of like over decorated, kind of like the one we're just looking at. That's part of what made me think about it. Like, right, like each room is just like a little bit disjointed from the others, but it's so like, you can just have a lot of good pictures in a property like this, and you sort of each time you go into a different room, it's a new sort of wow. And they have, again, they did a similar thing, pool table. They have a little shuffleboard in the back that, I mean, when you compare the two listings, the insides aren't that much different, but I mean, they are different, right? I mean, this kitchen is nice. Um, but so, I think they're doing a lot of the same things, but I think the property itself that they picked is one that's just going to be tough, right? The 3 bedroom, 2 bath, or like that one's 3 bedroom, 1.5 bath. Uh, is the thing that we're almost always trying to avoid that here. And I think, when I look all over in other markets, it seems like it's kind of the case everywhere, right? Like everybody basically just took their home and made it into an Airbnb. And I think if you just have that kind of average home, it's really hard to do well on the competing on experience and amenities. And so then you end up having to compete a little bit on price, or you just end up like where they were here, where they had like, um, just not great occupancy, right? I mean, it was, it's not terrible, but it wasn't great occupancy. And so, um, a lot of times investors have been doing that because they're like, well, I want it to work as a short term or a long term rental if I have to switch, right? So there's a lot of that, which I always think is silly. Like if you're a hotel operator, you don't buy a building and assume that you're going to use it as apartments if it doesn't work, right? Like you're just going to sell it if it doesn't work, and then maybe you lose some money, but sort of going halfway in between, I think is really tough. And so that's what I see a lot of these like 3-2 sort of normal homes that are trying to be wow on the inside, like they just end up to where they all kind of are the same. And, is there a risk that someday every property in my market's going to look like this one in the backyard? Like, I think that's possible. But I think that it's a little bit more defensible, right? Like, and so these types of deals, um, is what I'd really, if I want a short term rental, I either want one like this or I want one that's really optimized to compete on price. I don't want one that is just sort of straddling those two positions. Um, and so that's what I kind of think is wrong here. And then the other thing too is sometimes in certain markets, it's just the price of a home doesn't, there's not enough guest demand to justify the price of a home at a certain price, right? And so um, this would work perfectly fine if we were buying it for 280 or 300, but it's homes like this, based on the appraisal and everything, sell for 385. And so, and then if we have a little premium on top of that, then it's really tough to make it work. And so, especially with that loan, that's, when I say if this dropped down to 35, I would definitely buy it. I'd still be a little curious, a little worried about, that loan being in place, because even though the co-owner has to pay it, if they can't make that payment, and I think that's a real risk, right? Or it could be because we don't really have information about, everything else, what their finances are, right? Like that's one of the things that I don't love when you have, you're getting a rent credit from them, they're agreeing to pay that mortgage in perpetuity basically, or until it's paid off, and we don't really get any information on whether or not they're capable of doing that. And so, um, and so the risk is they default on it. The lender forecloses, right? Or we have to pick it up as and pay for it out of cash flow. Maybe in that situation, the entity could take more of the equity. I mean, it's not like, I don't necessarily think it's a catastrophic risk, but it is, when the property itself doesn't cover the debt that's existing, but that debt being in existence is the only reason we're getting the yield that we are, right? Like, because it's just that financial engineering where we're not paying for the debt and we're, but all of the cash flow is being spread across a small portion of the equity, or a small portion of the total price. Um, I care about it, right? And I think a lot of people are kind of ignoring that. I think that uh, understanding what that debt payment looks like relative to the cash flow. Now, if in the future this goes down or their revenue goes up, right? I mean, one of the things about short-term rentals are they do fluctuate quite a bit. I'm trying to see if they have. Oh, I gotta close this. Um, So yeah, and when I use the actual estimator, it gave me an even lower number than what it is. So they're doing a really good job in their market, right? Like they have about market occupancy, but I think they were at 269. So they're getting about $40 a month higher than the average daily rate. Um, this is the projected monthly revenue. Uh, how it's changed over time. So it really looks like this is being sold onto Lofty. Um, behind what are the best months for this property. Um, this is sort of interesting though. This is the trend line that they are basically uh, predicting, the annual revenue that they've predicted has just gone straight up on this. And that's one thing, I'm not really sure, it went up 37% year over year. Um, let's go back. But I don't know what created this, right? Like from January to January, it went straight down and then went straight back up. I don't know if there was some situation with the comps, right? Because all this is telling you is what it was, what the annual projected revenue had been if we had looked at this at any of these points in time. Um, Obviously, I'm glad we're on the right side of the trend, but I don't, without digging into it more. And again, if I wanted to buy this right now, I could ask some more questions in the Discord. I did see that there were some questions, and this person, the co-owner, she seemed to answer, be someone who's answering. And that's one of the things too, that why I like to wait and buy is, even if this was absolutely perfect, and I did miss one really good one. I missed that, one that went from 50 to like 60 or 70 right away. I'm still hopeful that there might be a dip in the future. But, much more often I missed ones that went down and then maybe later went and bought some lower. But what you can do is just get in that Discord. Not my Discord. I don't want to confuse the two. Get into Lofty's Discord, and look at the property channels and see how they've responded to questions, see how transparent they are about changes that are being made, how the accounting works. If you look in some of them, you're going to get much more detailed and thorough answers than others. Whether that's some of them like to share more or they're just more organized, or I get really nervous about some of them that are just like not really answering anything, or be like, "Oh, I'm working on it, and I'll let you know next month or in a few months." Like that is never instills confidence in me. Um, I think that's really all I want to say about this one. It is so, like I said, I mean, at this price point, it's not one that I'm going to buy. I'm curious what other people think, right? If you want to comment on this video, or like I said, jump into our, the chat on the Discord and talk about it. I'm curious if anybody has a different take on this one. Um, who if I know that I'm a very risk averse investor, it's done well for me, but I do sometimes miss out on upside. And is this current yield enough to get anybody excited about it? Or is the fact that it's really just, it's not even real yield, right? It's yield that's coming from a rent credit for a month, to bump December up to match November's gross. Um, I don't know. I think that there must be some pressure to hit that 20% number because that's where things are really selling out. I don't think that's really healthy for the platform. Um, I'm really curious to see how that works over time, right? Because one of the things that I think that's doing is filtering out a lot of people that would be selling good properties to the platform because they're like, well, I can't imagine giving up that type of yield up front, right? If even though, um, I don't know, I'm curious with that. I'm gonna have a conversation with a couple other people that are actually putting stuff on the site. I'm doing one on Monday now, so hopefully I'll get some of those questions answered, right? Like, how much pressure do you feel to do that 20%? Is it even worth it, right? To not just get your own equity financing elsewhere? Like, why? I don't know. I can't imagine bringing a property onto Lofty right now, having to hit that number, um, unless it was just one that I thought, oh, this is going to appreciate like crazy, and so I'll just dilute them later, right? Pay down that loan later, and benefit from it there. But I think it's hard. I think it's hard to see, other than that, why I'd want to carry $23,000 in annual debt on a property, um, that just can't cover it at the current run rate. And I don't know. I think that's all I'm going to say about that. I'm curious if anyone has any thoughts about it. Um, if any, if anybody has a specific price target on this one, I am, I talked to a couple other people about these, and so some of them have like really specific numbers. Um, and I'm just not doing that, right? It's not the way that, because like, let's say I pick, okay, $35 is where I want to be. And then you see, a certain month, and I followed along in the Discord, and I followed the updates, and I'm, still right around there is where I want to be. And you see some dumping in it because it has a down month, but it's a month that you expect to be down already. And it gets to like 36 bucks. Am I so sure that 35 is the right number that I'm not going to buy it at 36 when I know it's a big discount to the appraised value and it's been operating, at a certain level that I'm happy with the yield? Like that's one of the things, I spent a lot of time as a financial analyst and have just realized that like for large companies that, looking at real estate deals, and one of the things that, I just realized is like, oh, and I think it was an older guy at like an equity investment type firm that just told me, he's like, the only thing that all financial models have in common is they're all wrong. And, he was telling me this as I was like really trying to dial in something on something we were working on. And, that's something that I just took like, oh, okay, at that point in time. But as I've gotten, more experience, realize like, yeah, it's 100% true. Obviously we go through the motions, and you want to like take a look at what's my downside risk and what do I think this is going to do. But I never want to be so certain about any of my assumptions, um, that I wouldn't take advantage of something that seems like an obvious discount at the time, right? Like, I mean, that's the thing. Like, that's one thing that we can be more certain of than anything else is if we're getting a discount to today's prices. And so, and that's something, sometimes that's hard to monetize if this property doesn't then turn around and sell quickly. But it's something that I think can anchor, the price that I want to pay for a property, um, per token, can really anchor that price for me. Now I'm really done. Sorry, I feel like the last few videos towards the end I've rambled a little too much. I'm gonna try to reel that in. But I always just want to say one or two more things, and then I just, these go really long. So I'm going to stop now. Until next time, I'm going to keep making mistakes so that you don't have to.